Okay, let's jump right into this explainer. Today, we're tackling a massive dilemma. Honestly, a really stressful one that so many federal employees face right as they're gearing up for retirement. And that is evaluating those incredibly expensive life insurance premiums. If you are literally tossing and turning at night over whether to keep your FEGLI, your Federal Employees Group Life Insurance, you are absolutely not alone. We're going to break down exactly how to evaluate this choice, using the real-world experiences of federal workers who have already navigated this exact same maze.
So here's our quick roadmap for today. 1. The $650 monthly shock. 2. Do you still need it? 3. Exploring cheaper alternatives. 4. The 75% reduction strategy. And finally, number 5, your retirement coverage checklist. Let's get into it.
Starting with Section 1, the $650 monthly shock, the cost of keeping FEGLI. Let's look at that intense sticker shock that hits so many federal retirees right as they're finalizing their paperwork.
We're anchoring today's explainer on a real 57-year-old federal employee who suddenly realized exactly what they were up against. As they were planning for retirement, they discovered they were paying a staggering $650 a month for life insurance. I mean, to put that into perspective, for a lot of people, that is almost as expensive as health insurance. And as one retiree pointed out, these premiums can actually double every 5 years. We're talking hitting $400 a month or more just for standard multiples of their salary.
Just look at this quote. It brilliantly captures the anxiety of watching your hard-earned pension basically get drained by exorbitant insurance premiums. You work decades to secure comfortable FERS pension only to watch this massive chunk of it potentially vanish every single month just to maintain FEGLI coverage. It begs the absolute fundamental question, should you actually keep it?
Now, here is the really interesting part. That exorbitant cost, it's not a glitch in the system. As one experienced federal worker noted, FGLI is group term life insurance, meaning after retirement age, it becomes incredibly expensive on purpose. The system is deliberately designed to disincentivize you from keeping it. By pricing older participants out, it gets you out of the risk pool, which in turn lowers premiums for everyone else who's younger and still working. Crazy, right?
Moving on to Section 2, do you still need it? Evaluating your milestones. If the system is actively trying to push you out, well, let's pivot and ask the foundational question. Before we even figure out how to pay for coverage, do you actually still need it?
This right here is the absolute crucial question you have to ask yourself. Who is dependent on your income? You need to figure out if you're paying massive monthly premiums to protect dependents who, frankly, no longer need protecting. Life insurance is designed to replace lost income, right? But what if your income isn't the sole pillar holding up your family's financial survival anymore?
Let's look at our 57-year-old's milestones. This is a textbook case of someone whose financial assets have largely replaced their need for massive life insurance. Their kids? Adults, out of the house. Spouse has a good job of their own. They've built up a robust TSP alongside IRAs. They've got a FERS pension and Social Security on the horizon, and zero debt outside of a mortgage. I mean, if your profile looks anything like this, your financial assets have essentially become your life insurance.
And this highlights the general consensus among savvy retirees. The ultimate goal is to reach a point where your risk is covered entirely by your assets. Think about it. If your spouse gets half your pension, their own 401k, Social Security, and the kids are fully grown, you might be severely overinsured. As one retiree put it, unless you have special needs children or immense debt, keeping wildly expensive life insurance when you have millions in the TSP and zero dependents, it just doesn't make financial sense.
All right, Section 3, exploring cheaper alternatives, private term and WAPA. Because what if you evaluate your milestones and realize, okay, actually, I do still need some coverage. How do you get that without handing over $650 a month?
This comparison really nails your options. Over on the left, we've got the FEGLI trap, right? Premiums doubling every 5 years as you age, heavily draining your pension. But look at the right side. One federal employee shared how they bypassed FEGLI entirely, opting instead for a private 20-year term plan that provided $600,000 in coverage for exactly $600 a year. That is $50 a month compared to $650. And the best part? They just let it expire at the 20-year mark because by then, their TSP and pensions had totally replaced the need for it.
You also have highly specialized options built specifically for federal workers. Take WAEPA, for example. Their coverage is fully portable, meaning it is yours to keep right into retirement up to age 85. Plus, they offer these great calculators to help you intentionally wind down your coverage as your financial needs decrease. Or, alternatively, if you're a member of an AFGE local union, they often offer life insurance where the payments literally never rise, and you can even borrow against it without penalties. The main takeaway here? Cheaper, way more flexible options definitely exist outside of the standard federal package.
Okay, Section 4, the 75% reduction strategy. Demystifying the math. Let's dive into the secret weapon that so many retirees ultimately choose when they just refuse to pay those exorbitant fees.
Let's break down the plain language mechanics of exactly how this works. Step 1. You keep your FEGLI Basic coverage and pay a relatively low premium until you hit age 65. Step 2. The second you turn 65, all premium payments stop entirely. Done. Step 3. Your coverage amount begins to drop by 2% every single month until it settles permanently at 25% of its original value. Basically, your beneficiaries are left with a permanent payout roughly equivalent to a quarter of your final salary for the rest of your life.
To really put this into perspective, one federal retiree noted they paid just $48 a month from age 62 to 65. That $48 secured an insurance policy worth their entire annual salary. And then, boom, at 65, the premiums completely vanished, and the coverage safely coasted down to that permanent 25% floor.
Now, a lot of people like to call this 25% coverage free. And sure, as some rightly point out, it's not strictly free because, you are paying premiums up to age 65. But man, the return on investment is massive. As one retiree joked, there's a huge ROI on those 5 years of basic premiums, even if you'll be too dead to enjoy it. I mean, if your final salary was high enough, that 25% can easily mean a $30,000 to $50,000 payout. It acts as an incredible tool to effortlessly cover funeral and final expenses without eating into the pension your spouse is relying on.
All right, let's bring it all home. Section 5, your retirement coverage checklist. Let's translate everything we've talked about today into a clear, actionable checklist for your own retirement planning. Use these points to systematically evaluate your own situation. First, do you actually have anyone dependent on your current income, or are the kids out of the house? Second, do your TSP, IRAs, Social Security, and FERS pension provide enough of a safety net for your spouse? Third, if you decide you do need coverage, have you actively priced out private term life or WAEPA instead of just blindly accepting the FEGLI defaults? And lastly, does taking the basic 75% reduction make sense to lock in that permanent final expense coverage based on your current age?
So here's the bottom line. Your financial situation evolves, and your insurance strategy absolutely needs to evolve right along with it. Take a hard look at your numbers, run the calculators, and make sure your money is working for you, not the risk pool. I'm going to leave you with this final thought to help you decide when it's time to stop relying on life insurance for your financial survival. Is your life insurance genuinely protecting your family's future, or is it just draining the pension you worked your entire life to build?